Well, good morning, Jagendra Rana here. Why budget holds key to growth in 2026? This is the topic of our discussion today. Why budget holds key to growth in 2026? 2025 was well played by Government of India, but persisting challenges ranging from a whimsical US admin to sluggish credit growth and risk of inflation at home and abroad call for more reforms. The year 2025 will be remembered as one when India turned global challenges into a catalyst. While trade wars flared and capital flows swung wildly across markets, India quietly rewrote its playbook, leaning on domestic demand, bold reforms and strategic trade moves to keep growth on track. Meanwhile, economic fundamentals improved. Growth firmed, inflation hit a decadal low, consumption surged, and a long-awaited sovereign rating upgrade signaled confidence in the country's fundamentals. Now, when the calendar has flipped to 2026, so the question is not whether India can grow, but now it will sustain momentum amid an unpredictable world. With prudent policies and strategic investments, the country can reinforce its position as one of the fastest growing major economies in a volatile world. So, looking back, global economic shifts triggered by policy overall in Western economies sent ripples across trade and investment market in 2025. India faced its share of turbulence, higher US tariffs on exports, record foreign portfolios outflows, and the rupee sliding past 91 to dollar briefly. Yet domestic demand, the country's biggest strength, proved to be its anchor. But that was not more coincidence. Fiscal policy led by Shah Budget 25-26 introduced long-awaited tax exemptions for the middle class, and government later rationalized GST slabs, boosting disposable incomes and consumer confidence. The public investments in capital formation and infra remained robust. Monetary policy complemented these efforts with RBI pivoting sharply from tightening to easing, cutting rates by 125 basis points to revive credit growth. Labor reforms also broke new ground, with long pending labor codes finally implemented, promising easier compliance, job formalization, and overall improvement in ease of doing business. Externally, India recalibrated its trade strategies. The India-UK Free Trade Agreement was a highlight, and progress towards an EU pact signals ambition to anchor in high-value markets. Meanwhile, India depend ties with emerging economies across Asia, Africa, and Latin America, regions projected to outpace global trade growth. These move reflects a broader shift towards South commerce, with implications for supply chains and digital services. Now, at the start of 2026, the previous year's report card looks impressive. Private spending surged, aided by tax relief and better rural conditions, while government capital expenditure soared. 51.8% of allocation was utilized in the first half of the fiscal year. So manufacturing and services grew over 9%, with the services now accounting for 60% of gross value added and nearly half of exports. So GDP growth hits 8%, and in August, India earned its first sovereign rating upgrade in 18 years, a symbolic nod to its resilience. So the year ahead, however, uncertainty persists. The US-India trade deal remains elusive. The question is not if, but when, as steep tariffs on goods weigh on India's exports as well as investments decisions. So not to forget disruptions to trade and slowing of major economies and could pose a challenge for India due to its dependence on these nations. Three domestic risks warrants close attention this year. First, big credit transmission remains a structural challenge. Despite aggressive rate cuts by RBI, lending growth, especially of MSMEs and households, and has lagged, raising concerns about the effectiveness of monetary policy for stimulating demand. Second, inflation could resurface as consumption accelerates and core inflation stays above 4%, particularly if supply side bottlenecks persist. So besides, there are risks of imported inflation from the West as price pressures are being felt in US due to higher tariffs. Not to mention further depreciation of the rupee could also fuel imported inflation. Finally, there might be fiscal pressures as tax revenues slow down due to the recent reforms amid slowing exports. This could restrict government's ability to spend next fiscal, thereby limiting the growth push. Now, next budget pivot. The upcoming union budget is expected to pivot from demand pull to supply side reforms. The focus will be wide ranging with a priority focus on MSMEs, infra, innovations and R&D and further reforms to improve ease of doing business across sectors. So one of the key measures would be around streamlining customs processes, which has already been hinted at. Relief measures such as tax breaks and credit guarantees for tariff hit sectors, textile, jewelry, auto rims are expected for MSMEs. So expect easier credit access through cash flow based lending, digital platforms and dedicated liquidity funds. Budget may pivot attention from just fiscal deficit to debt to GDP trajectory, creating more fiscal space for capital investments. So thank you very much.